Welcome to the Planning for Life podcast with certified financial planner professional Russell Jacobs and financial life advisor Carl Coolidge. Carl and Russell will share creative strategies and ideas for overcoming challenges in your personal and financial life. Inevitably, life happens, and we will empower you to reach your destination. Thanks for joining us. Now, on to the show.
Hello and welcome to another podcast with Jacobs, Coolidge and Company. Today, we have a very special guest with us, Jim Jacobs, who's another one of the financial advisors in the firm who specializes in working with 401ks, is our guest on the show today. And he's going to talk a lot about what's going on in the 401k market and what you need to know as a participant of that plan. Jim, welcome to the show.
Thank you, Matt.
Let's jump right in, which is what have you experienced with plan participants? I mean, what sort of relationship do you have? What sort of, just kind of give us an insight on what it's like working with plan participants.
Well, with plan participants, they are like anyone else. You know, we deal with participants that are hourly all the way up to highly compensated. And generally, some of the concerns all tend to be similar. You know, how much should I contribute? Am I doing what I should be from the start? So it's a variety of concerns, but that tends to be the number one, is how much should I contribute?
Okay. And so that is their biggest concern, is that they need to know how much. Now, do you do that as a fixed percentage, or do you do that as a dollar amount? How do you open up that conversation? With
their biggest concern, generally the first question I get is, am I saving enough?
With that question, how do you figure that out, Jim? I mean, how do you maybe push the envelope a little bit and make sure that they're saving enough? Do you have a big picture retirement question for them? Help me with that.
Yeah, the first thing we generally talk about and what they're curious about is the matching component.
Okay.
So most plans have some form of a match, and they want to know what is the amount they can contribute to take advantage of all the money the employer will put into the plan for them. And so a lot of times that might be 5% is the number. And so they want to know that, but then also, is that enough? Is there anything else I need to be doing? So we talk about that in a little more detail.
What does that mean, though? They're asking a really long-term question, though, aren't they, Jim? Which is, what is enough? How do you make that decision? Because you're talking to people who are all over the pay scale.
Right. It will be different case by case. Industry averages tend to be in that 10 to 20% of your pay, but that is definitely a ballpark number. I would say that from day one, if you start right when you get the job participating in the plan, even if you think you can't afford, let's just say 5% to get started or 10%, start somewhere. But each person is different. You know, you have this balance between living your life and saving so you can still live your life when you retire. And some of that is pretty complex because people don't realize what you really need to save to pay yourself in the future. Mm-hmm. And so drilling down to their situation, their expenses, lifestyle, how much they need to replace in the future, really I know it sounds cliche, but the better, the earlier you can do it, the better off you'll be. Mm-hmm. But I would always start with the match or more if you can handle it.
What is the biggest mistake you see plan participants make?
By far, not participating.
Okay.
There are a couple of different scenarios with that. Not participating from day one is just, it kills it long term because a year will go by, 2 years will go by. You also get used to your paycheck when you don't participate right from the start. So it goes into the checking account. And most people, when it hits the checking account, well, there's something that you need to buy. But if from day one you sign up and participate, well, that money never goes into the checking account. So if you don't see it, you don't miss it. A lot of plans do have auto enrollment now, and that helps. But generally, that will start at a percentage that is lower than the matching. If that's the case, another common mistake, same scenario, a year or two go by, and they will not have increased the percentage to take advantage of the match or more. Now, that's a common thing I hear regularly is, I have been meaning to talk to you for so long. That's a very common problem. And they don't realize that If you project that out many, many years or decades down the road, you're talking about thousands and thousands of dollars.
Nobody probably wants to leave or get fired from their job, but when they do, what are they supposed to do with their 401k when they leave or start that new job?
Well, each plan can be a little different. They usually have a minimum account balance. Let's just say $5,000. If your balance is below that and you do nothing with it, it will eventually auto roll to a mutual fund company. That is a pretty common problem, and it can be an issue because if that happens to you, it will roll into an individual retirement account or IRA that is in cash, so it will not be invested. And those can sit around for an extended period, not invested, they're not earning anything, and you can lose track of it that way. That's one thing to think about. The other options you have, if your balance is higher, your plan may allow you to keep it as is. It will stay invested. There's no new money would go into the account. So you could do that. You could also roll it to an individual retirement account or IRA. With that, you will no longer be in the 401k plan or company's retirement plan, obviously, but that would open up some different investment choices. I always encourage, if you go that route, work with an advisor that you're comfortable with, develop a long-term plan, and invest accordingly.
Okay. Why should you buy life insurance outside of what is being offered by your company, and why is it so important to buy it when you're young? With
life insurance in your group plan, a lot of employers will offer a multiple of your base pay. That could be 2 times your base is the most common that I see with group plans. And if you have loved ones or family members that you care about, 2 times your base might sound like enough money if something happened to you, but usually it is not. And the reason being, if you need income from that money that comes in, 2 times your base will run out very, very quickly for your family. And when you're younger and you buy up in your group plan, it usually is less costly. But as you age, the amount that you have purchased will increase over time. And that leads to a problem when you're much older, because if you want to continue having that coverage through your group plan, it will cost a significant amount. So you have to decide if you want to keep the coverage or stop paying for it and losing the protection for your family. When you have it outside of your group plan, that doesn't happen. If you can get approved early, your ongoing costs will be lower. So as you age, just like anything else, it increases in cost. You also tend to expose yourself to different medical events. So let's say you're 40 instead of 20, your chances of having some type of health issue are going to increase each year. And when you're purchasing life insurance in your 40s, 50s, 60s, whenever it is going to cost more each year. So buying early protects you from everything we've talked about. It also gives your family more protection that you have control of. And if you switch jobs, you still have it. If your company changes your group benefits, you still have coverage. So it offers several layers of protection, and an advisor generally will help you decide what amount outside of your group is appropriate to protect your family and the ones you care about.
When it comes to what's inside the plan, why is diversification and asset allocation so important?
Diversification and asset allocation is just a very important part of your plan. The younger you are, you have a longer time frame to retirement. So if you get the allocation diversified, but also take enough risk to try to earn a better rate of return, you can handle the fluctuations in value from year to year over the market. So the more risk you take, you typically will average a much higher rate of return over time. Now, as you progress through your life and get closer to retirement age, you want to look at how much risk you take each year. And especially the closer you get to retirement, when you're going to turn from saving the money to paying yourself the money, is when you want to insulate yourself from having the really large swings if the market is up or down. But when you have a plan in place and are diversified, those dramatic increases or decreases in value that will happen over time become a little smoother ride. I compare it to a roller coaster. Let's say you're at an amusement park and you have the big ride that has the peaks and valleys that is a little more intimidating. That is like the peaks and valleys in the market. And the good thing about being diversified is that ride is a little less scary. It will be smoother and make the swings not as difficult to deal with. And the other benefit when you're participating in your retirement plan at work is that no matter what is happening with your diversified portfolio, you're buying with your money and usually the employer's money through the match every time you get paid. And when the market is down, people tend to get a little bit more fearful. But when you're buying with your money and the match, all of the investments in your plan are at a discounted price. So you're getting more for your money. Then the market, when it goes back up, you're still contributing. But the snowball effect and compound interest over time is just a great combination for you to have enough to live on when you retire.
Let's go back to the match, because if, let's say the employer is going to match 4%, how should you then just put in the 4%? And I also want to talk about how does all of this affect you from a tax perspective? Are there favorable tax consequences for putting more into a 401k, just doing the match? Break that down for us, Jim.
The match is very important, and it is the most common percentage that people contribute in the plan is to try to take advantage of the matching. Well, that is definitely a good thing. What you have to think about, though, is let's say it is 4%. Is that going to get you where you need to be in the future? Probably not. And you really need to look at doing as much as you can and go back to that industry average of 10 to 20% of savings will generally give you more options when you retire. Because that's all you're really trying to do. It's long-term saving, but you are creating your own paycheck. And the more you contribute, it's very simple, the more you will have when it is time to pay yourself. The matching helps plan participants immensely having that in place. It is a great benefit, but there usually needs to be an additional amount saved to give you more options, or even if you want to retire at an earlier age. So yes, it is great to take advantage of the match, but you don't want to be stagnant and just sit on that number generally. A lot of times it will take more than that. So that is a common error, I would say, is just getting set with that one number and not going above or using other vehicles to supplement what you're doing through your retirement plan.
Now, from a tax perspective, how does participating in your 401k affect you from a tax perspective?
Right. That is pre-tax contributions to the plan are the most common that people are familiar with, and they have a great benefit. A good example, let's say you make $50,000 a year and you contribute $5,000 to your retirement plan. You would be taxed on $45,000 of income. So most people are familiar with that. You are getting the tax deduction. The money goes into the plan. When you retire and take the money out, it is all ordinary income, so you have to pay taxes on that money. More commonly now, plans are offering a Roth 401k or Roth retirement plan, and that is another benefit that you can take advantage of, which is after-tax dollars that go into the plan. So the difference between the two, with the Roth money, you are giving up the tax deduction up front. You pay taxes on your contribution, it goes into the plan. Whatever that grows to be in retirement, when you pay yourself from it, you do not have to pay taxes on the Roth portion or the after-tax money. So the younger you are, the Roth will tend to look favorable, and you don't have the situation of paying the IRS in retirement. So the two have advantages. That's something that age is a factor because of giving up the tax deduction. But the Roth retirement plan money does also not have income restrictions. And that is one of the main benefits of the Roth.
This is a morbid question, Jim, and I'm sorry that I want to ask you this and that I really should ask you this, but what happens when you die when you're participating in 401k?
Very important question. If it is a spouse-to-spouse transfer, so a married couple, the spouse is the beneficiary, that money would go to an IRA or individual retirement account that will be registered in their name. It is not a taxable event. It just becomes retirement money for the remaining spouse. What another common situation is a non-spouse beneficiary. And in that same situation, say a son or a daughter or family member is the beneficiary, it would go to a beneficiary or inherited IRA, which is still retirement money, But at that point, when it is pre-tax dollars, that beneficiary would have a required minimum distribution that they have to remove from the account each year. But those are really the two situations. Spouse to spouse is very efficient because it's just a retirement account for the remaining person. When it gets a little different when it is a non-spouse beneficiary, because the IRS requires you to take some of the money out to get revenue from the deferrals they let you have in the retirement account for the person that passed away.
Jim, if somebody's been listening to this podcast and they say to themselves, I really need to talk to somebody who knows more about 401ks, especially if they work within hospital systems or in the medical community, what is the best thing for them to do and how can they reach you?
All right, to get in touch with me, my office number is 912-265-2876. You can also send me an email. That address is jameslJacobs@financialguide.com.
Closing thoughts. What are the final parting thoughts that you would like to give our audience about 401ks?
I would say the very important starting place would be to talk to an advisor, maybe the advisor on the plan, or talk to someone locally to have that relationship, because there are a lot of things they can do to lay out some of these plans. So are you contributing enough to your 401k? Do you need additional insurance to protect the ones you care about? You know, the insurance portion of it with your overlaying with your group benefits is really important because that is a foundational element to everything that you're doing. So when life throws you a curveball, which as we all know, that does happen, your plan takes care of either you or your loved ones. You adjust your plan after that event and move forward. So it is all tied together, which I think makes it really important to have that person that you trust, because it's all about protecting you and your family. I mean, it's all a love-based situation, you know, as funny as that sounds, but it all works together. You can factor in Social Security in the future. You know, that's another piece of the puzzle. And so to just, in short, have that relationship. If you're not dealing with an advisor, start early and often saving. You know, you don't need a person to do that. You know, if you don't have that advisory relationship, you can still do it yourself. But it's all tied together. Look at all of it, spend the time to do it, you know, and have that trusting relationship. I think all of those together will dramatically increase your odds of success over the years.
Wonderful. Well, Jim, thank you very much for your thought leadership today on 401ks.
Thank you very much, Matt.
And if you have not subscribed to the podcast yet, make sure you click that subscribe now button below. And if you know somebody who is asking questions about their 401k, chuck them this podcast and make sure that they have a chance to listen to it by just clicking that share button below. For everybody at Jacobs Coolidge and Company and Jim Jacobs, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content is developed from sources believed to be providing accurate information. The information in this material is not intended as tax or legal advice. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Russell C. Jacobs III, Carl B. Coolidge, James Jacobs, and William Schwartz are registered representatives of and offer securities, investment advisory, and financial planning services through MML Investor Services, LLC, member SIPC, Supervisory Office, Jacksonville, Florida. Jacobs Coolidge and Company, LLC is not a subsidiary or affiliate of MML Investor Services, LLC, or its affiliated companies.